In today's video, we're going to be talking about the tax filing status after the death of the spouse. There are a few options, but it's something that you need to think about because there's some planning ideas that you can do prior to this happening to take advantage of some of these rules, so stick around. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management. We're trying to bring informative retirement videos to you so that you can better plan for retirement. If you need help and you want to work with one of our advisors, click right up here. Today we're talking about the tax filing status after the death of a spouse. So in most cases, you'd be generally filing taxes, married filing jointly, up until that year. Now the IRS does give you one more year so that you can do married filing jointly in the year that your spouse passes. In the next 2 years, you can file as a qualifying widow if you meet certain requirements. Then if you don't qualify for that, you'll be filing single. So what are some of the things that you can do in that final year where you can get the married filing jointly? The first thing that pops into my mind is doing a Roth conversion because the married filing jointly tax brackets have a lot more room in them as opposed to the single tax brackets. You'll have one more year where you could do a larger Roth conversion than you could once you get the single bracket and get more advantageous tax rates. After the first year, if you qualify for the qualifying widow or widower, you get 2 more additional years to file under these provisions. So what are the requirements? The first one is if you qualify for married filing jointly with your spouse for the year that he or she died. It doesn't matter if you actually filed married filing jointly, it's just that if you qualified. The second requirement is that you didn't remarry before the close of the tax year in which your spouse died. Another requirement is that you have a child, stepchild, or adopted child that you claim as a dependent. This does not apply to foster children. The last requirement is that you paid more than half of your cost maintaining your home. This also must be the main house for your dependent children. Another thing that makes filing jointly beneficial is the standard deduction is higher. If you can do married filing jointly or qualifying widow, the standard deduction is $27,700. This is a huge advantage. When you eventually get back into filing single, the standard deduction is only $13,850. So if you can meet these requirements, you get the $27,700 deduction in the year of your spouse's death. And you can also get that higher deduction for the first 2 years if you qualify as a widow or widower. And if you can't meet those requirements, then you'll have to start filing as single. So let's take a look at the brackets. The first bracket is 10% for both single filers and married filers. You'll see that for single it goes up to $11,000, for married it goes up to $22,000. So they basically doubled it. The 12% bracket goes up to $44,725 for single filers and for $89,250 for married filers. Let's just say, for example, that you have a federal pension and Social Security and you're taking distribution from your TSP, and maybe your income is $125,000 in the year that your spouse was living. So you'd be in the 22% bracket. Now, after the death of your spouse, you would lose the lower Social Security. So let's say that your $125,000 income drops to $100,000. If you're still married filing jointly, you'd still be in the 22% bracket. However, if you look at the single bracket, anything over $95,376 is in the 24% bracket. So this shows the example of why a single tax bracket is not as advantageous as a married filing jointly. If you wanted to max out the 22% bracket in our example, we said that they had $125,000 of income in the year of the spouse's death. You can see the 22% bracket goes all the way up to $190,750. That means there's around $65,000 of room before you max out the 22% bracket. Whenever you go to the single bracket, under this example, you're going to be in the 24% bracket. This lets you Roth convert $65,000 at the 22% bracket of the tax rate, as opposed to waiting until next year when you're going to be in the 24% bracket as a single filer. So this is just something to think about. Anytime there are some advantages that you can take, we definitely want to help people do that. So obviously, if you're going through the death of a spouse, you have a lot of things going on, and financial planning is probably not high on your list. But this is one of the good reasons to work with somebody that understands these rules so that they can help you. As you're going through the grieving and the family things that you need to do, a financial advisor can be there to help point out and help lead you to do the best planning that you can do without taking up much bandwidth from you. You have more important things to worry about during that time. Well, if you got value out of this video and you want to watch this one, what do you do financially when a loved one dies? There's a checklist of things that you need to be doing to make sure that your financial house is in order. My name is Mel Stubbs. Talk to you next time.